Every year, sometime between late January and April 15th, most Americans do something that almost no one in any other wealthy country has to do. They sit down at a kitchen table or in front of a computer and they reconstruct their own financial life for the government. They gather their W-2s and their 1099s, their mortgage statements and their student loan interest forms, and even their child care receipts. They then enter numbers from one form into boxes on another form. They answer questions about things that happened 12 months ago, and they try to remember whether they moved, whether they married, or whether a dependent aged out of a credit they've been claiming for years. And then they pay someone to help them do it, or they pay a software company to walk them through it, or they pay a tax preparer at a storefront in a strip mall, handing over documents that contain their social security number, the name and age of every child in their family, and a complete record of every financial decision they made in the previous year. And when it's all said and done, they've spent an average of 13 hours and $290 telling the government something it mostly already knew. Your employer, after all, sent a W-2 to the IRS that had your pay. Your bank sent a 1099, and your mortgage servicer reported your interest payments. The brokerage reported your dividends. So the IRS received all of it before you ever opened a single envelope. In most cases, the government could tell you what you owe. It could send you a bill, or a refund, or even a simple confirmation that you're good. We're square. Collectively, Americans spend over 7 billion hours each year complying with the federal tax code. This includes gathering, calculating, and filing. And if you add the out-of-pocket costs on top of the lost time of productivity to do those taxes, the total cost comes to over $460 billion a year. That $460 billion amount is more than the entire combined proceeds from federal corporate income tax, which are the taxes paid by America's largest companies on their profits. All that money just to tell the government what it mostly already knows, and what almost every other industrialized country does without middlemen involved. And that time and money is only part of what having to pay someone to do your taxes costs you. You're handing over a picture of one of the most private things in your life, your personal financial privacy, your income, your debt, your children's names and ages. And all this is going into a private company's database. And in many cases, that company has a specific plan for what to do with it, a plan that doesn't end when your return is filed. That is the second bill, and that bill doesn't have a dollar amount. I can't tell you what that's worth. And quite frankly, it doesn't have to be this way. Right now, more than 36 countries, including the United Kingdom, Sweden, Denmark, and Japan, handle taxes for most of their citizens with little to no filing required at all. And for 2 filing seasons, the United States had a version of that. It was a free government-built tool that let you file your federal taxes directly with the IRS. It didn't need a software company or involve upsell screens. And it definitely didn't cost $290 for the individual to do it. But it no longer exists. This episode is about how all that happened, not just in 2025, but over the 80 years before it. A tax for everyone. There is something that would surprise most people if they heard it. For the first 30 years after the income tax was created, the overwhelming majority of Americans had absolutely nothing to do with it. The federal income tax was ratified as a constitutional amendment in 1913. That first year, fewer than 400,000 Americans filed returns. The instructions fit on a single page. The tax applied to incomes above $3,000, which is close to $100,000 in today's dollars. A surtax, which is basically a tax on top of a tax, kicked in above $500,000. It was, by design, a tax on the wealthy. A factory worker, a farmer, a school teacher, or a store clerk, none of them were expected to file anything. The income tax in its original form was simply not part of ordinary American life. And that remained largely true for the next 3 decades. By 1939, only about 5% of American workers paid federal income tax. Filing a return was something merchants and manufacturers and wealthy lawyers did. And if those that did file needed help with it, they could walk into their local Bureau of Internal Revenue office, that's what it was called back then, and have a government employee prepare it for them, free of charge. The idea that tens of millions of working Americans would someday spend a significant portion of every spring gathering documents and filling out government forms would have seemed to most people alive in 1940 like a description of someone else's country entirely. Then came the war. The United States entered World War II in December of 1941, and the financial demands were immediate, and they were enormous. Congress made the decision to reach into far more pockets. The Revenue Act of 1942 did exactly that. President Roosevelt called it the greatest tax bill in American history. Time magazine was somewhat less celebratory, describing it as the biggest piece of machinery ever designed to separate dollars from citizens. And both of those statements were pretty much true. There was also the aspect of inflation that drove this action as well. But the story of monetary policy and the larger tax story is something that deserves its own episode. For our story here, the important thing to know is that 1942 was when the tax law shifted and set the stage for everything else that followed. The act dramatically expanded the number of Americans subject to income tax. This was part of a wartime transformation that took individual returns filed from roughly 15 million in 1940 to nearly 44 million by 1943. It did this by repeatedly and aggressively lowering the income thresholds at which the tax kicked in. People who had never owed $1 of federal income tax in their lives were suddenly taxpayers. As Treasury Secretary Henry Morgenthau put it during debate over the measure, for the first time in our history, the income tax is becoming a people's tax. The class tax had basically become a mass tax. This created an immediate practical problem. The government now needed tens of millions of people, most of whom had never dealt with the federal tax system in any way, to calculate what they owed and to pay it. The old system assumed a relatively small number of filers who could manage this annual reckoning. In the very first year of the modern income tax, in 1914, field agents calculated the bills and sent them out. Early 1040 instructions told taxpayers to ask their local collector of internal revenue for assistance. The system did not scale to tens of millions of people. The solution the government landed on was withholding. But that story is more complicated than it's usually told and involves a patriotic propaganda campaign, a year-long congressional brawl, and a set of consequences that are still with us today. That full telling deserves its own episode. For our purposes, the short version is basically that in 1943, the federal government began taking withholding from workers' paychecks and sending the money directly to Bureau of Internal Revenue throughout the year. The model had already existed through the functioning of Social Security, which had been doing something similar since the late 1930s. One of the young Treasury employees who helped design the system, Milton Friedman, later wrote about how it was a tool meant for wartime and not for the peace afterwards. Friedman went on to become one of the most prominent free market economists of the 20th century, and also a Nobel laureate. So the war eventually ended, but the withholding did not. And the withholding didn't eliminate the return. The system in place still made the return necessary, but in a different way. The system that emerged between 1942 and 1943 had three interlocking parts. Withholding collected wages at the source throughout the year. Information reporting required employers, banks, and financial institutions to send income records directly to the government, which gave the IRS independent documentation of much of what you earned before you filed anything. This made the annual return the reconciliation layer. It was basically the document that brought all of it together, settled the difference between what had been withheld and what was actually owed, and accounted for everything that fell outside of the withholding. That third piece, the reconciliation, could not be handled by withholding alone. Withholding only captures wages. It didn't capture interest on savings accounts, dividends from stocks, income from a rental property, or gains from selling an asset. The income tax had evolved to be a tax on a person's full economic life. In 1943, when millions of ordinary Americans were making record amounts of wages, with the economy at near full employment, withholding captured one stream of their income. The return was the net that caught everything else, and the return carried a legal condition that's worth talking about. Every Form 1040 is signed under penalty of perjury. Federal law makes filing a materially false return a felony. The IRS's own materials describe the system as one of self-assessment, with taxpayers calculating their own liabilities. What that means in practice is that the filer bears legal risk and exposure with their filing. If the government calculates wrong, that's the government's error. If the taxpayer calculates wrong, it's the taxpayer's legal problem. Now, is this right? Well, this episode isn't meant for that question. but it's worth bringing up as food for thought. So anyway, the government created tens of millions of new filers. It shifted the liability of accuracy to each of them individually, and it calibrated the withholding tables so that most people overpaid throughout the year, which meant a refund would arrive in the spring. The government does not pay you interest on that overpayment. It does charge you interest if you underpay. What this arrangement produces behaviorally is something the industry that grew up around it would eventually understand very well. Most Americans don't experience April as a moment of paying the government. They experience it as a moment when money arrives. The refund becomes an event to look forward to. For a while, the service to help individuals with their tax forms at those local offices continued in the post 4 years. But eventually, the agency that had been doing that helping found itself in a crisis. In 1951, the Bureau of Internal Revenue was engulfed in a scandal. A House subcommittee led by Representative Cecil King of California had been pulling on a thread that ran through the Bureau's field operations. Those field offices were composed of politically appointed collectors of internal revenue and were the ones who actually ran local tax administration across the country. What the investigation found was bribery, shakedowns of taxpayers in difficulty, and a pattern of senior officials covering up for those below them. Multiple collectors resigned under a cloud of suspicion or were fired. Officials in Missouri went to prison. The structure that enabled the corruption was the same structure that had enabled the help. The 64 collectors of Internal Revenue were political appointees, basically local figures who owed their positions to party loyalty rather than civil service examination. That decentralized relationship-based system was what allowed an ordinary taxpayer to walk into an office and get personal assistance. It was also what made those same offices vulnerable to corruption and to graft. President Truman's response was found within Reorganization Plan No. 1 of 1952. It abolished all 64 collector offices and replaced them with civil service district directors, accountable to Washington. Truman framed this as an improvement in taxpayer services. The formal promise was a cleaner, more honest, and efficient agency. On July 9, 1953, the Bureau of Internal Revenue became the Internal Revenue Service. What happened to free preparation services in the years that followed is not a clean story. Part of it involves the massive 1954 change in the tax code, but that, along with some of those other things that I mentioned earlier, are going to be part of a different episode. Starting in 1955, the IRS reportedly started pulling support for individual tax preparation at those local offices. It started in Kansas City, of all places. And it's in that city H&R Block's own founding history records that the founders, who ran an accounting company called United Business Company at the time, benefited from that removal of personalized help. When I dug deeper, the drawback from local help seemed to coincide with the introduction of IBM computers for the processing of returns. Kansas City was the first introduction of this new method that IRS was using. The Block brothers expanded to New York, which seemed to have occurred right before the IBM was instituted for that IRS office following the one in Kansas City. It appears that the first nationwide tax-preparing monopoly of H&R Block started with a family business targeting areas where the IRS was drawing back, piece by piece. By the 1950s, tens of millions of Americans now had a legal obligation to file a federal tax return every year. Most of them had their taxes collected automatically before they ever saw the money. But at year's end, they still had to produce a sworn document accounting for their full income, their deductions, and their liability. And the code they were reconciling against was already growing. The original 1913 income tax, which was the amendment text combined with the Revenue Act, only ran a few dozen pages. By the time the wartime changes were complete, the code had expanded to thousands of pages. That growth would continue as Congress used the tax code to deliver social benefits, reward certain behaviors, and respond to every economic crisis and political compromise that came along. Each edition made the code that much harder to navigate. Today, depending on how you count it, the full body of federal tax law, along with the codifications and the regulations, runs into tens of thousands of pages. And it's basically a moving target. The code changes on average hundreds of times per year. None of that complexity was designed in a single sitting. It accumulated the way complicated systems always do, one provision at a time, with the costs and the contradictions becoming only visible after a distance. A credit for one industry, a deduction for a social goal, then a clarification that required 3 more clarifications. Complexity of this kind isn't neutral in its effects. For the person at the kitchen table or trying to start a new business, it's a barrier. But for those with the resources to navigate it or to lobby for provisions within it, it could be something more useful. In some ways, it becomes a protective moat for the powerful interests or businesses that are at the top of the apex when those tax provisions are pushed forward. A private monopoly expands. By 1962, the H&R Block Company had more than 200 offices and went public that year at $4 a share. By 1978, 1 out of every 9 tax returns filed in the United States had been prepared by H&R Block. The Block brothers built a seasonal storefront model for their tax work. I guess you could equate them to Spirit Halloween stores that pop up in late September or early October, but without the costumes. Anyway, eventually the tax business would move outside the storefront and into the living rooms of people's homes. And certain industry players would use lobbying and money to create the legal reality to make this happen, and to ensure that the government never rebuilt the free service it had discontinued. Before that story fully unfolds, we first need to look at what enabled this shift. And quite frankly, it started with a floppy disk. The digital moment. In 1984, a programmer in San Diego named Michael Chipman bought an IBM personal computer to do his own taxes. He wrote software to do it. He recognized that other people might find it useful and began selling it by mail under the name TurboTax. By the mid-1980s, personal computers were entering American homes in significant numbers for the first time. Tax preparation plus software seemed like a natural fit, since the task of calculating taxes was rule-based and the inputs were standardized. If you could get the rules right and the interface simple enough, the software would do what a paid preparer did faster and cheaper. Chipman's timing was almost perfectly aligned with 2 other developments that would determine the shape of the industry for the next 4 decades. The first was the Tax Reform Act of 1986. President Reagan signed it in October of that year, using his trademark soothing voice, calling it a tax code designed to take us into a future of technological invention and economic achievement. It was, though, the most sweeping overhaul of the federal tax code in 30 years, with hundreds of provisions restructuring rates, deductions, and credits across the board. It expanded the alternative minimum tax, which originally was designed to catch a handful of wealthy tax avoiders. That expansion, however, would eventually affect millions of middle-class households. It also changed depreciation rules and capital gains treatment in ways that required new calculations and new forms. And as I pointed out in my episode titled Who Closed the American Mall, it had a massive impact on the real estate market. The second development was seemingly smaller, but actually quite large in its consequences. In that same year that Reagan signed the Tax Reform Act, the IRS quietly launched an electronic filing pilot program. This involved 5 tax preparers in 3 cities: Cincinnati, Raleigh-Durham, and Phoenix. This resulted in 25,000 returns filed via modem over the phone lines. The following year, the program expanded and continued expanding. By 1990, e-filing was available nationwide, and millions of returns were coming in electronically. But there was a catch. From the very beginning of the 1986 pilot, individuals couldn't transmit their own returns directly to the IRS. The IRS could have built a system that accepted returns directly from individual filers. Other designs were proposed. Some members of Congress actually called for direct filing, which was the ability for a taxpayer to transmit their own return to the government without paying an intermediary to do it. Instead, the IRS required that electronic returns pass through an authorized e-file provider, which involved select private companies approved by the IRS. Fees for directly filing in those early years ran from $25 to $75 per return, and those were fees just for the electronic transmission. That didn't include the fees that those preparers charged. Meanwhile, the software side of the story was accelerating. Scott Cook and Tom Prox co-founded Intuit in 1983, and its first product was Quicken. Intuit went public in March 1993 and acquired ChipSoft, the maker of TurboTax, in December of 1993. That acquisition gave Intuit the dominant consumer tax software platform in the country at precisely the moment electronic filing was going national. Instead of a seasonal storefront on Main Street, the middleman was becoming more and more a program on an individual's computer. But the relationship between taxpayer and government was still the same in one way. A private company stood between the taxpayer and the government they were paying. And electronic filing was something you couldn't do yourself according to the law. Another change that came with electronics was the economics. H&R Block could serve people one at a time across thousands of offices, each requiring a physical location. TurboTax, with its automated process, could process millions of returns simultaneously at near zero cost per additional user. And there was something else even more significant. It had to do with data. Every return processed by TurboTax was a data point. Tens of millions of the most precise and complete financial portraits that existed anywhere were flowing through a single private platform every spring. And the importance of this data and how your data now is the product can be seen in a statement that was made after a large acquisition. Decades after Intuit acquired TurboTax, it acquired Credit Karma, with the company telling investors it had roughly 70,000 tax and financial attributes per consumer. But the privacy aspect of giving your information to these companies, that's a different story. Our focus on this episode is the history and monetary costs of going through private companies in the first place, and how those private companies worked hard to protect their role as the gatekeeper of tax returns. Throughout all of this, industry insiders were constantly on the lookout for what some in the industry termed encroachment. To many in the industry, that word encroachment meant any effort that made their role obsolete. And by the late 1990s, Congress was about to hand the IRS both a mandate and a reason to do exactly what those private tax preparers feared the most: the 1998 pivot. By 1998, electronic filing had been growing for 12 years, but was still reaching only a fraction of American taxpayers. That year, roughly 23% of individual returns came in electronically. But the Internal Revenue Service Restructuring and Reform Act of 1998 would change that number. It was the most significant overhaul of the agency since the 1950s. It reorganized the IRS from a geography-based structure into one organized around types of taxpayers. And tucked inside it, in Title II, was a declaration that would shape the next 25 years of American tax filing. Congress declared that paperless filing should be the preferred form of filing for federal tax returns. It set a goal of 80% of all returns to be filed electronically by the year 2007, and it set cooperation with the private sector as the preferred way to reach that goal. The IRS, working under the 1998 mandate to expand e-filing, began developing what it called the Easy Tax Filing Initiative. This was a direct government tool that would allow taxpayers to prepare and file returns online for free without going through a private company. The Bush administration, coming into office in 2001, initially supported the concept. The private tax industry, not surprisingly, opposed it. The framing was focused on government competing with private enterprise, and it found a receptive audience in an administration that was already supportive of privatization. That arrangement was solidified in October 2002. That's when the IRS signed an agreement with a group of private tax software companies that became known as the Free File Alliance. The terms were supposedly a compromise. The companies would provide free filing software to taxpayers below a certain income threshold, and in exchange, the IRS agreed not to build a competing direct filing system of its own for as long as the alliance agreement remained in effect. The agency that had once prepared returns for free at local offices across the country, but then stopped, and then watched a private industry grow in the vacuum it left, had now signed a contract promising it would never re-enter the space. The agreement required the companies collectively to cover at least 60% of taxpayers with some free option. But each individual company only had to cover 10%, and the agreement covered federal returns only. The state returns became the industry's primary upsell, the product that converted a free federal filing experience into a paid one. The arrangement was presented publicly as a win for American taxpayers. The government had secured free filing for most Americans without spending public money to build a system. The private sector would provide the service. Everyone would benefit. The reality that unfolded over the next 2 decades, however, showed a different truth. During the first 20 years of its existence, its use never went beyond 7% of all tax returns filed. The refund trap. So let's talk about refunds. But I don't want to dwell on the fun side of it, the fact that you may be receiving one. Instead, I want to talk about how the private tax filing systems use psychology to get a piece of a refund that is supposed to go to you and your family. It started with a simple observation about timing. Electronic filing made refunds faster. Before e-filing, a paper return could take 6 to 8 weeks to process and a refund check to arrive. Electronic filing compressed that to 2 or 3 weeks, sometimes less. For a taxpayer living paycheck to paycheck, the difference between waiting 2 months for a refund and waiting 2 weeks was significant. And for the tax preparation industry and banking industries, that significance represented an opportunity. If a taxpayer was going to get a refund in 2 or 3 weeks, a preparer could offer to advance that refund immediately in exchange for a fee. The refund was coming anyway. The preparer was simply lending the amount against it, collecting when the IRS paid out. The loan was secured by a future government payment. This is the first opportunity, and it was called refund anticipation loans. By 2004, 12 million American taxpayers were using them annually. The fees varied by provider, but annual percentage rates routinely ran from 36% to over 500%. A taxpayer paying $100 in fees to access a $2,000 refund 2 weeks earlier than they otherwise would have received it was paying an annualized rate of return that would be illegal in most other lending situations. Studies found that over 60% of individuals taking the advance received the Earned Income Tax Credit, which is a federal program specifically designed to supplement the incomes of low-wage workers and their families. Refund anticipation loans are no longer available, but they only ended because the IRS announced it would no longer provide tax preparers with the debt indicator tool. This told lenders whether a taxpayer's refund would be seized to pay back taxes or other federal debts. Imagine that you had these private entities that would find out about someone having their money seized before the person would. The industry replaced those loans with a product that accomplished roughly the same thing, and this was done by extracting money from the filer's refund instead. Rather than lending the refund amount, preparers began offering what they called a refund anticipation check. This is a temporary bank account opened in the taxpayer's name, where the IRS would deposit the actual refund when it arrived. The preparer would then deduct its fees and release the remainder to the taxpayer. Technically, this wasn't a loan, so there weren't interest charges. But instead, there was a fee for the temporary account as well as the ability to defer paying the tax preparation fee until the refund came in. That deferral is a product's supposed value proposition, as well as its cost. If a taxpayer pays $30 to defer payment of a $200 tax preparation fee for 3 weeks, the APR is equivalent to 260%. But again, it's not interest, right? By 2015, about 19 million taxpayers were using this product for a total cost of over $400 million annually. This product exists today under the name Refund Transfer at H&R Block and Refund Processing Service at TurboTax. TurboTax charges $40 for it. And the way this is structured, whether intentionally or not, creates a particular psychological effect. Because the fee is deducted from a future payment rather than charged at the point of transaction, there is no price pain at the moment of sale. Psychologically, it's not considered a loss. There's also things that are involved in the software that also seems to have psychological effects. The flash of green numbers and the dollar sign at the end of a long process in that software, with a promise of no cost now, triggers the same type of reward centers in the brain that gambling does. In 2017, a new version of the advance refund product returned. Congress passed legislation requiring the IRS to delay refunds for returns claiming the Earned Income Tax Credit or the Child Tax Credit. This was claimed to be a fraud prevention measure that extended the wait for refunds from 2 or 3 weeks to 6 or more. The preparers responded by offering what they called no-fee advances. TurboTax's Refund Advance, which it advertises at 0% APR with no fees, is this product. But the cost is in a different form since it requires opening a Credit Karma money account, which requires these individuals to agree to additional terms of service, which often means more information of what they use to file their taxes can be used for potentially other things. The deal that protected the market. Let's go back to the 2002 Free File Agreement. As I mentioned earlier, most of America's lowest income earners were supposed to be able to use the free file system that was run by the industry, but only a fraction actually did. And as the evidence shows, it seems that in most cases, they didn't even know it existed or were redirected to paid products before they could reach it. This happened often when they were actually searching for it online. TurboTax operated 2 distinct products under names that are very close to each other and can be easily confused. The first was TurboTax Free File. This was the actual IRS partnership product. and was available only to taxpayers who qualified by income or other criteria. It was accessible through irs.gov. The second was TurboTax Free Edition. This was a separate Intuit product, marketed aggressively across the internet under the word free, and it was available to anyone who searched for free tax filing. The free edition was free for the simplest possible returns, but it was not free for anyone with student loan interest deductions or with health savings account contributions or a host of other financial realities. And for those using it, you often wouldn't find out it wasn't free until after filling out all the data and spending all that time doing it. You'd be confronted with a message that's saying that your situation is too complex for the free tier and asking for a credit card number. But it gets worse because in 2019, reporters uncovered something that made the lack of users on the genuinely free version not much of a mystery. ProPublica's reporters examining the technical architecture of TurboTax's website discovered a piece of code embedded in the free file page a few characters long. No index, no follow. That code basically told Google and every other search engine not to list the page in search results. H&R Block had done the same thing with its own free file page. The 2002 agreement was eventually modified in 2019. The addendum prohibited companies from hiding their free file pages from search engines. It also lifted the IRS's restriction on developing its own free filing tool. That modification, which was quietly made at the end of 2019, is what made direct file legally possible 4 years later. Door opens, door closes. After watching this far, you understand something that most Americans didn't understand when news broke in 2025, that a government free tax filing program had been canceled. You understand what it was replacing. You understand who built the system it threatened. With all of that context, here's the story of direct file. In August 2022, President Biden signed the Inflation Reduction Act. This law allocated $80 billion to the IRS over 10 years for enforcement, technology, and service improvements. Tucked inside it was a smaller provision, $15 million for the IRS to study whether the government could build its own free electronic filing system. Not through partners like it did back in the 1990s, but actually on its own. What they built was the opposite of everything the private industry had spent decades constructing. There were no upsells or upgrade prompts. There was no screen asking whether you wanted to share your data with a network of financial partners. And there was no free edition that turned out to not be free. Direct File was a mobile-friendly, interview-style tool that was available in English and Spanish. It walked taxpayers through their return by asking plain language questions rather than requiring tax expertise. It pulled in data the IRS already held, and when you were done, you had filed your taxes. That was the entirety of the transaction. The 2024 pilot launched in 12 states for taxpayers with simple situations. Over 140,000 taxpayers filed successfully. They claimed more than $90 million in refunds, and they saved an estimated $5 million in preparation fees on federal returns alone. A Government Accountability Office survey of more than 11,000 direct file users found that 90% rated their experience as excellent or above average. Among users who had filed with a state integrated version, 93% preferred direct file to their previous filing method. Now I want to take a pause here because I don't want to seem like I'm a cheerleader for this. I have a lot of concerns about how the tax situation works in America, especially when it comes to enforcement and seizure, because, last time I checked, we still have a Constitution with the Fourth Amendment. But the point I want to bring across is when you have something that is low cost like this and provides such a huge benefit overall, I think it's better to have more options than not. But that's been the problem because every time the government tries to provide an option, there's an attack basically saying that, well, you're anti-market or you're anti-competition. Should there be a competition for filing taxes with the government? But of course, that's a whole nother debate and not really part of the scope of this video. What I really wanted to get across is, obviously, there are benefits to having the additional aspect and choice than just having private industry alone. In May 2024, Treasury announced it would be made permanent. The 2025 season brought expansion to more states, with the number of taxpayers using it more than doubling. But of course, the private tax preparers' response to all this was, well, unsurprising. Intuit spent nearly $4 million on federal lobbying in 2024. It was its highest annual total ever recorded. H&R Block spent $2.4 million in lobbying efforts. In January 2025, Treasury Secretary Scott Bessent, at his Senate confirmation hearing, committed to keeping direct file available through the 2025 filing season. That next month, February of 2025, Elon Musk posted on X that he had deleted 18F. This was the government technology team that had helped build and maintain DirectFile. But it seemed premature because DirectFile was still operating, but the post was widely covered. Taxpayers who had been considering using the tool were now uncertain whether it still existed. Then that following month, in March of 2025, IRS staff assigned to develop DirectFile for the 2026 filing season were told to stop work. The $30 million engineering and design contract that had been projected for that development was never executed. By July of that year, of 2025, at a tax professional summit, IRS Commissioner Bill Long commented on it. "You've heard of DirectFile," he said. "That's gone. I don't care about DirectFile, I care about Direct Audit." Then, in November of 2025, the IRS sent an email to the states that had been participating in DirectFile. The program would not be available for the 2026 filing season. The revolving door. Let's now talk about movement. Not the movement of money, but the movement of people. The movement of the specific individuals who understood the system from the inside. You know, the ones who had spent years inside the IRS or inside Congress, and then moved into positions where that knowledge went to work for the industry they previously regulated. Let's start with the Free File Agreement itself. The IRS's lead negotiator on the Free File deal, that person that represented the government in that 2002 agreement, he ended up going to work for Intuit. The pattern repeated at the Federal Trade Commission. The FTC had jurisdiction over deceptive advertising practices. When the FTC eventually investigated Intuit, the company's outside legal representation included a former FTC commissioner. But it goes beyond the executive branch and extends into the halls of Congress. The committees that write the tax laws, the House Ways and Means Committee, the Senate Finance Committee, they have staff counsel who spend years developing detailed expertise in the mechanics of tax law. And a number of officials that worked in these committees ended up working for the tax preparation companies or their trade associations. That's the revolving door, and it seems money is what keeps that door turning. The rest of the world. So we're at the point of the story where it's worth stepping back from the specific history of the American system and ask a simple question. Is this normal? Is paying a private company to help you meet your legal obligation to the government and handing that company your most sensitive financial information simply what paying taxes looks like? When you look at the rest of the world, the simple answer is no. More than 36 countries have implemented some version of return-free or pre-filled filing. The list of countries include the United Kingdom, Germany, Japan, Sweden, and, well, most of the rest of the developed world. They include countries with complex economies, with large populations, diverse income sources, and extensive tax codes. In Sweden, the Swedish tax agency sends every registered taxpayer a pre-filled return based on information it already has. The taxpayer reviews it, and if the information is correct and there is nothing to add, they just confirm it. The entire interaction for most wage earners takes minutes. In Japan, the system works a little differently, but to the same effect for the majority of workers. Most salaried employees are not required to file a national income tax return at all. Their employer performs what is called a year-end adjustment. This is a reconciliation of income and withholding on the employee's behalf. If the employee has no significant income beyond their salary, the obligation is settled without the employee ever submitting a return to the government at all. These systems are not perfect and aren't without critics. Tax authorities make errors in pre-filled returns, and taxpayers who accept pre-filled data without careful review sometimes miss corrections that would have reduced their liability. But my point isn't to advocate for any of those systems. My point is to show that we seem to have the most inefficient and costly system when it comes to privacy and personal costs in tax filing. The United States built its mass tax in 1942, let the government's free preparation service lapse in the 1950s, and watched as private industry grew in the gap. And then, through successive changes in law, helped the middlemen charging you to do your taxes become more and more entrenched. This whole story has been more than a story about just you going to a private vendor or a private company. to do your own taxes. It's a story about who gets to stand between a citizen and their government, generally, and what they get to charge for being there, and what happens when the government briefly remembers that it doesn't have to have anybody stand there at all. That's the story where things stand and how the vast majority of Americans, over 90%, pay somebody else to do their taxes.